Welcome back to the Explainer. Today, we're doing a high yield exam review so you can walk in and confidently calculate true profit. If you've been, struggling to figure out exactly when to recognize expenses versus when to just completely ignore them, well, you're in the exact right place. We're going to lock down the core accounting principles and tackle the practical calculation scenarios you literally have to master before test day. Let's get into it. So, how do you calculate true profit? Sounds simple, right? But to answer this correctly on your exam, we have to look way past the obvious. You actually have to look past the timing of cash flow and rely on a fundamental, unbending accounting principle. I mean, you can't just look at a company's bank account balance and actually know how well the business is performing. It's a classic trap. Okay, let's take a super quick look at our roadmap for today so you know exactly what we're covering. We've got 1. The matching concept defined. 2. Why matching matters. 3. Matching costs to revenues. 4. Time-based recognition rules. And finally, 5. Accruals and adjustments. All right, section 1, the matching concept defined. Look, if you don't understand the why behind the rule, the calculations are just going to feel like memorizing random formulas, which is the worst. So here's your foundational definition. The matching concept states that expenses incurred in an accounting period absolutely must be matched directly with the revenues earned during that exact same period. Think of it kind of like pairing items up. You can't claim the reward, the revenue, without simultaneously recognizing the sacrifice, the cost it took to get there, all within that exact same specific accounting year. So, when you're staring down a practical calculation question, the actual formula is remarkably straightforward. To arrive at the net result for the period, you simply deduct the sum of the appropriate costs from the sum of the recognized revenues. It's that simple. But the magic, and honestly the challenge, lies entirely in identifying what makes a cost appropriate and when a revenue is actually truly recognized. Moving right along, section 2, why matching matters. Now you might be wondering, why don't we just calculate profit based on the cold hard cash sitting in the bank account? Well, this concept is crucial because it ensures financial statements aren't completely distorted by cash flow timing. Imagine a business buys a massive amount of inventory for cash on, say, December 31st. If we just looked at the cash, it would look like a terrible month of massive losses. But they still have all that valuable inventory, right? Matching allows you to ascertain the true performance of the business by smoothing out those deceptive spikes and dips that are caused simply by when a check happens to clear. Okay, section 3, matching costs to revenues. Let's look at our first major practical calculation scenario. When you're preparing a profit and loss account, a super common trap is using total production costs for the year. Don't do it. Remember, you must strictly match the cost of goods actually sold against the sales revenue for that year. If a factory produces 100,000 units but only sells 80,000 this year, you only deduct the cost of those 80,000 units against your revenue. The cost of the remaining 20,000 units, that gets held back. It's not expensed until those specific items are sold in the future. Next up, section 4, time basis recognition rules. Okay, let's break down your two main expense categories. First, your everyday operating expenses, things like salaries, wages, rent, interest, insurance. These are recognized based on the time period they actually relate to. If your team worked in December, that is a December wage expense, even if payday isn't until January 5th. Second, think about long-term fixed assets, like a giant factory machine. You obviously don't expense the whole machine on day one. Instead, you match it to revenues by allocating its cost over its useful life in the form of depreciation. You basically take a little piece of that cost and match it to the revenue it helped generate each year. So the absolutely crucial takeaway here is that the passage of time, not the date of cash payment, is what triggers the recognition of these specific expenses. If you're reading an exam prompt and it goes way out of its way to tell you exactly what day a utility bill was paid in cash, be on high alert. The examiner is definitely testing to see if you'll take the bait. Just ignore the cash payment date. Focus purely on the time period the service was actually used. Which brings us to section 5, accruals and adjustments. All right, let's tackle the trickiest exam topic to calculate. This is literally where most students drop points if they aren't careful. For your exam calculations involving accruals and adjustments, I want you to mechanically follow this sequence. Step 1, forcefully pull everything into the current year that was earned or incurred, even if not a single penny of cash exchanged hands. Just get it on the books. Step 2, ruthlessly back out any cash exchanged this year that actually belongs to past or future years. Did you pay next year's insurance premium early? Exclude it. Received a customer's deposit for work you haven't even done yet? Exclude it from this year's revenue. Let's apply that to a real calculation. Say a business earns $1,000 in monthly rent from a tenant, but the $1,000 in cash for December physically hasn't arrived by December 31st. Well, you still add that $1,000 to the current year's revenue calculation. You earned it this year, so it absolutely goes on this year's scorecard, period. Keep this punchy little rule vividly in your head on test day. Deliberately exclude past and future cash. Seriously, if the economic activity didn't happen between January 1st and December 31st of the year you're analyzing, it has no business being in your calculation for that year's true profit. And honestly, this brilliantly illustrates how carefully pairing the timing of revenue recognition with cost recognition provides a logical, accurate, and totally fair view of financial performance. It's not about hiding money, right? It's about making sure that anyone reading those financial statements gets an incredibly clear, undistorted picture of what the business actually achieved through its operations during that specific time frame. So as you head into your exam, ask yourself this every single time you read a prompt. Are you getting distracted by the deceptive timing of cash flow, or are you looking at the true matched performance of the business? Stick to the matching concept. Rigorously pair your costs with your earned revenues, ignore the cash dates, and you're going to nail these calculations every single time. Good luck with your review, and we'll catch you in the next explainer.